It's actually hard to look at the screen right now and make sense of what we're seeing without assuming something is fundamentally broken in the plumbing. I've been staring at two numbers all morning, just two numbers, and honestly, they shouldn't exist on the same planet, let alone on the same trading day. If you look at your standard feed, if you're just checking the spot price on your phone or watching the futures contract in New York, you're seeing a market that looks, well, it looks heavy. It looks like it's rolling over. You see that flush down to the low 80s, you see the margin hikes kicking in, and the technical damage looks real. If that's the only window you have, the story is sell. The story is liquidation. But then you look east. You look at the Shanghai Gold Exchange benchmark, and you realize that while New York is selling paper, Shanghai is paying a 40% premium for the actual metal. Let me say that again, because I don't think it sinks in the first time. 40%. We aren't talking about a shipping dislocation. We aren't talking about a 50-cent spread because of a holiday squeeze. We are seeing physical silver trading at the equivalent of $112 an ounce in China, while the futures market in the West is struggling to hold 86. This isn't an arbitrage opportunity. It's a fracture. Usually, when you see a gap like this, even a small one, say $2 or $3, the bullion banks step in immediately. They lease the metal in London, they fly it to Shanghai, they sell it, and they pocket the difference. The gap closes. That's how efficient markets work. It's supposed to be seamless. But the gap isn't closing. It's widening. And that is the thing that should keep you up at night, not the price drop in New York. That's noise. The signal is the fact that the metal isn't moving fast enough to fix the price. It tells me that the pipes are clogged, or worse, the metal isn't there to move. I want to walk you through exactly what this looks like structurally, because this isn't about silver to the moon or any of that hyperbole. This is about a mechanical failure in the way price is discovered globally. We are watching the pricing power shift from west to east in real time, and most people are too focused on the daily chart to see the tectonic plates sliding underneath them. The last time we saw a dislocation even remotely close to this was decades ago, and the outcome changed the market structure for 10 years. So put the charts away for a second. Forget the RSI, forget the moving averages. We need to talk about the physical inventory drawdowns and why the paper market is suddenly completely blind to what is happening on the ground in Asia. Because if you're positioned based on what Comex is telling you, you might be betting on a reality that stopped existing 3 days ago. Here is what I'm saying. The first thing you have to understand is who is actually selling right now, because if you get this wrong, the rest of the analysis is useless. I'm looking at the order flow coming out of New York over the last 48 hours, and it's mechanical. It doesn't look like human decision-making. It looks like a forced liquidation event. You have to remember, the CME Group raised margin requirements on silver futures by over 15% late last month. That's a massive capital call. It's not a gentle tap on the shoulder. It's a margin clerk grabbing you by the collar and telling you to post cash or get out. So the funds, the managed money, the CTAs that trade purely on momentum, they didn't sell because they think silver is overvalued. They sold because they had to. They were over-leveraged. The margin requirement hit, and they dumped contracts into a thin market. That is what pushed the price down to that $86 level. It's artificial. It's a liquidity event, not a value event. But here is where it stops making sense. Normally, when you have a liquidation event in the futures market, the physical market cools off. Buyers step back. They wait. They say, oh, the price is crashing. Let me see if I can get it cheaper next week. That is standard behavior. You see it in copper, you see it in oil, you see it in gold. But China isn't waiting. While New York was puking up contracts, the Shanghai Gold Exchange saw volumes explode to the upside. We aren't seeing a wait-and-see approach. We're seeing a panic bid. The benchmark price in Shanghai didn't even flinch at the Western sell-off. It held firm around 22,000 RMB per kilogram. If you do the currency conversion, and I did it 3 times this morning just to be sure, that's roughly $112 an ounce. Think about that spread for a second. You have a trader in Chicago selling a paper promise for $86 and a fabricator in Shenzhen buying the real bar for $112. That's a $26 gap. In a functional market, that gap lasts for minutes, maybe hours. We're now in day 3 of this dislocation, and the gap is actually drifting wider, not tighter. This tells me that the arbitrage mechanism, the machinery that keeps global prices aligned, is broken. And the people who are misreading this are the ones assuming that the futures price is the real price. They think the paper market discovers value. But right now, the paper market is just discovering how much leverage is in the system, while the physical market is discovering how much metal is actually left in the vault. Who is exposed here? It's the bullion banks holding short positions on Comex. They are short paper, betting on a price drop, but they are obligated to deliver physical metal if those contracts stand for delivery. If the price in Shanghai stays this high, every ounce of silver that isn't nailed down in London or New York is going to get put on a plane and sent east. It's simple math. If you can buy here for 86 and sell there for 112, you do it. You do it until the vaults are empty. So the banks are trapped. If they let the paper price rise to match Shanghai, they get blown out on their short positions. If they keep smashing the paper price down, they just accelerate the physical drain because they make the metal even cheaper for the Chinese buyers. It's a feedback loop from hell. And I want to be clear about something. This isn't just about the Lunar New Year. I know the mainstream financial press is trying to pin this on seasonal holiday demand. I saw a report this morning from a major desk claiming this is just pre-holiday restocking. That is lazy analysis. Seasonal demand creates a premium of maybe 1 or 2%. It doesn't create a 40% fracture. You don't pay a $30 premium just to make jewelry for a holiday. You pay that kind of premium when you are terrified you won't be able to get the metal at all next month. This is industrial panic. We are seeing reports, and these are quiet back-channel reports, not press releases, that solar manufacturers and electronics firms in Asia are front-running their supply needs for the entire year. They see the same charts we do. They know the deficits are real. So when they see the paper price drop, they don't see a sell signal. They see a discount on a scarce asset. They are essentially raiding the Western store shelves while the Western store managers are busy marking down the price tags. In a minute, I want to show you why that margin hike I mentioned earlier might have been the trigger for something much worse than a price drop. But first, you have to look at the volume profile. If this were just a price spike in Shanghai on low volume, I would dismiss it. You can move a thin market easily, but the volume is screaming. It's heavy. This is institutional size moving into physical delivery, and it's happening exactly when the inventory levels in Western vaults, the LBMA and Comex eligible stocks, are sitting at multi-year lows. This is the contradiction that nobody wants to talk about. We have the lowest visible inventory in years, colliding with the highest physical premium in history, and yet the official price is down. That is not a sustainable state. That is a coiled spring. And the people who are going to get hurt are the ones playing the technicals on the futures chart. They look at the breakdown below $90 and they see a bearish pattern. They're shorting the whole. They're selling into the support because the chart says so. But the chart only tracks the paper trades. It doesn't track the cargo ships leaving for Shanghai. When that physical reality hits the paper market, it doesn't happen gradually. It happens all at once. It's what we call a limit up event. The shorts try to cover, but there are no sellers because the sellers have already shipped their metal to Asia to capture the premium. This is where most people get trapped. They wait for the chart to confirm the reversal. By the time the chart confirms it, the gap has already gapped up. I'm watching the exchange for physical or EFP numbers closely. This is a mechanism banks use to swap futures for physical metal. Usually, it's a boring number. Right now, it's showing signs of stress. It suggests that parties are desperate to get out of their futures obligations and get their hands on actual bars. And yet, the price on your screen is red. It's frustrating to watch, I know. It feels like gaslighting. You see the demand, you see the shortage, but the price tells you the opposite. But you have to trust the physical signal over the paper signal. The physical market is the dog, the paper market is the tail. The tail can wag all it wants, but eventually the dog goes where it wants to go. And right now, the dog is running east. This brings me to the mechanism that is actually driving this, because it's not just buying. There's a structural leverage point that just broke, and most analysts are completely ignoring it because it's boring technical plumbing. But it's the reason this spread isn't closing. The mechanism we need to talk about is the broken bridge between the two markets. In a textbook world, arbitrage is instant. Computers see the price difference, they execute the trade, and the gap vanishes. But we don't live in a textbook. We live in a world of logistics, capital controls, and import quotas. Here's the friction point that nobody is discussing: the China import quota system. You cannot just load 5 tons of silver onto a plane in London and sell it in Shanghai tomorrow. You need a license. You need a quota allocation from the People's Bank of China. These quotas are strict, they are finite, and they are controlled by the state. Normally, the quotas are sufficient to handle the flow, but when you have a violent surge in demand like this, a 40% premium explosion, the quota system acts like a bottleneck. The door is too small for the crowd trying to get through. This means the metal is physically stuck on the wrong side of the border. It is sitting in London vaults, technically available, but it cannot cross into the Chinese market fast enough to crush that premium. This is why the spread persists. It's not because the market is stupid, it's because the market is gated. And this creates a terrifying scenario for the shorts. If the metal can't get into China fast enough to lower the Shanghai price, then the only other way for the gap to close is for the Western price to rise. That is the mechanism. The paper price has to chase the physical price because the physical metal is locked behind a regulatory wall. The West has to re-rate higher to stop the drain because it can't flood the East to lower their price. Now, here is the behavioral signal that most people are ignoring. Watch the bullion banks. Usually, when a premium gets this high, you see banks aggressively shorting the Shanghai contract because they know it will revert. They bet on the gap closing. But look at the open interest data on the Shanghai Exchange. It's not spiking with short sellers. The banks are standing aside. They are terrified of this trade. They know that if they short Shanghai and the metal doesn't arrive in time, they get carried out on a stretcher. Their reluctance to step in and arbitrage this spread is the loudest signal in the room. It tells you they don't trust their own ability to source the metal and deliver it. If the biggest players with the deepest pockets and the best logistics networks are afraid to touch this spread, why on earth would you be betting against it? This is the difference between what looks important and what moves outcomes. The price on your screen looks important, but the reluctance of the banks to defend that price is what determines the outcome. Now, I want to pause here for a second. I want to be intellectually honest with you, because I'm not here to sell you a doom and gloom narrative just for clicks. I need to tell you exactly what would prove me wrong. What would invalidate this entire thesis? If we wake up tomorrow and see the Shanghai premium collapse by 20 or 30% on massive volume without the Comex price moving, then I am wrong. That would mean this wasn't a structural shortage. It was just a speculative bubble in China, a gamma squeeze driven by retail gamblers that popped. Or if we suddenly see the LBMA release data showing a massive, unexpected influx of silver into London vaults, maybe hidden stockpiles coming out of the woodwork, then the shortage narrative is dead. If the metal's there, the price will crash. I am watching for those two things every single hour. If I see them, I will flip my stance immediately. I have no loyalty to a trade, only to the data. But as of this moment, neither of those things is happening. The premium is sticky and the vaults are drawing down. So we are left with a binary setup. The paper market breaks. The shorts on Comex realize they're on the wrong side of the arbitrage wall. They panic cover and we see a violent snapback in Western prices to close the gap to $100 plus. Path B. The Chinese government intervenes. They force the Shanghai Exchange to raise margins, they ban certain types of trading, or they release strategic state reserves to smash the price down manually. Those are the only two ways this resolves. One is a market explosion, the other is a government crackdown. And in the next minute, I'm going to tell you exactly how I'm preparing for that binary outcome, because there's a specific playbook for this that doesn't involve blindly buying calls and hoping for the best. This is the part where most people want a prediction. They want to hear silver to $200 or get out now. But if you've been in this game long enough, you know prediction is a fool's errand. The market can remain irrational longer than you can remain solvent, especially when governments are involved. So instead of predicting, we prepare. We look at the scenario tree. Scenario 1, the market snapback. Probability, high. This is the scenario where the dam breaks in the West. The Shanghai premium acts like a magnet and gravity eventually takes over. The Comex shorts get squeezed not by news, but by the sheer physics of the arbitrage. The consequence, you will see a gap up open in New York. The market won't trade sequentially. It'll close at 88 and open at 95. The risk, volatility will kill you. If you are leveraged to the hilt, the intraday swings, the whipsaws, will liquidate your position 5 minutes before the rocket takes off. The clearinghouses will raise margins again. They will change the rules of the game to protect the solvency of the members. If you are playing on high margin, you are playing Russian roulette with a semi-automatic. Scenario 2, state intervention. Probability, medium. China decides the speculation is destabilizing. They step in. The consequence, overnight, the Shanghai price crashes 20%, not because of supply, but because of a decree. The risk is if you bought physical metal based on the Shanghai price, you take a haircut on paper value. But, and this is critical, you still own the ounces. The premium might vanish, but the underlying supply deficit hasn't changed. The thesis is delayed, not destroyed. This is why I am not chasing the futures market right now. I am explicitly not buying short-dated call options. That is a donation to the market makers. The premiums on options are jacked up because of the implied volatility. You are overpaying for the right to be right. I am also not shorting the spread. I am not betting on the gap closing by selling Shanghai and buying London. That is a widowmaker trade. The graveyard of traders who bet on spreads reverting is vast and full. Here's what I'm watching closely. I am watching the deliverable inventory at the Comex warehouses, specifically the registered category. If registered stocks drop below 30 million ounces, that's the red line. At that point, the exchange has a mathematical problem. They cannot cover the paper claims. That's when force majeure gets whispered in the hallways. I am also watching the premium on physical coins in the US retail market. Why? Because retail is the canary in the coal mine. If US premiums start to spike, if you see silver eagles trading at $15 over spot again, it means the contagion has jumped from the wholesale market, 1,000-ounce bars, to the retail market. That's when the general public wakes up. That's when the FOMO starts. My stance is for higher prices, but I am positioned in assets that don't have margin calls. I want exposure to the price without the exposure to the rules committee. I want to own the thing that cannot be rehypothecated. If the price crashes tomorrow because China bans trading, I sit on my hands. I know the geology. I know the mines are depleting. I know the solar panels need the metal. The price suppression is a gift, not a punishment. It allows me to accumulate more real wealth for less fiat currency. But if the price rips, if the paper market finally capitulates to the physical reality, I don't sell. I don't trade the breakout. I let the market reprice the asset to its fair value, which frankly is multiples of where we are today. We are watching a slow-motion train wreck of the paper derivative system. It might take a week, it might take a month, but the tracks are broken. I'm not telling you to buy. I'm telling you to open your eyes. The price on the screen is a lie. The price in Shanghai is a warning. And the empty space in the vault is the truth. So I have to ask you one question. When the dust settles and the paper contracts are settled in cash because the metal is gone, do you want to be holding the receipt or the rock? Let me know in the comments. Do you think the Western markets will allow the price to rise, or will we see a regulatory intervention to cap it? I read every single one of your takes because honestly, the crowd often sees things the experts miss. I'll be tracking the vault drawdowns daily. The moment I see a significant break in the registered category, I will post the update. Stay liquid, stay skeptical. See you in the next one. It's actually